In the last hour, Cliff and I spoke to University of Chicago former professor of Cliff's, Eugene Fama. He won the Nobel Prize in economics last year for his efficient market theory, which basically holds that all information about a security is already priced in, and it's all but impossible for an individual investor to beat the market. But on the other side of the ring, Yale University professor Bob Shiller has a different theory for how markets work, and he also won the Nobel last year. Professor Shiller, thank you for being with us this morning. Cliff, I'm going to let you kick it off.
Sure. First, Professor Shiller, I hope that you, like me, were very long shrimp last month. That's a joke.
Sorry.
No, we don't long shrimp either. I just told Stephanie we don't time the market, and that includes the shrimp market.
Yeah.
You know, myself and one of my partners, John Liu, just wrote an article on what we call the split Nobel Prize between you and Professor Fama. And our view was it was a very good thing. For one thing, we think we come out somewhere in the middle of you guys. And for another, we think both of you have advanced the literature and our knowledge so much. We did talk to Gene just now. We talked about efficient markets. Why don't we start off with you giving me your version of the inefficient markets case, if you can sum it up. Why are markets not efficient?
Well, first of all, I'm an admirer of Gene Fama, and I think that his theory of efficient markets is a half-truth, so he's half right. The fundamental thing is it's not easy to make a lot of money trading. It's a competitive game, and there's a lot of smarter people than you out there as well. That's where it stands.
Do you mean me personally on that, or is that?
Yes.
He's speaking with the universal Cliff again.
But that's just common sense. You know, people knew that long before Fama. What Fama did is present some evidence that looked very favorable, like these event studies that he did. It looked amazing, like markets are really perfect. But I think they gave kind of an exaggerated sense of perfection of markets. And when you really get down to the truth, what's driving the whole stock market? Fama would say, apparently, that it must be news about important real things that really matter. And I don't think so. I think the stock market the overall market is probably driven mostly by psychology.
Is there any possibility of a meeting in the middle at the long term? Where prices are eventually right?
I don't think that. The funny thing about, we spent a lot of time talking, Gene and I, at the Nobel Week. The funny thing is that, more or less, we don't disagree that much, except for interpretations. And he keeps coming back to this idea that markets are perfect. Yeah, I think as being kind of a fundamentally oriented investor for the long term, something like that is what we call value investing. And that, by the way, is substantially what Gene Fama does, or at least the company he advises, Dimensional Fund Advisors. So it's largely a difference of interpretation. Gene Fama doesn't seem to think that we should all just be completely diversified.
So are you saying people can beat the market? I just want to get an understanding of where you see the biggest challenge to this efficient market hypothesis.
Well, it's easy to beat the market historically. For example, one can just go into a value stock. Over the long haul, value stocks have outperformed the market. And there's a number of anomalies in the literature that it's not so hard to. It's not going to make you suddenly rich, but you'll beat the market in the long run.
I started this, and I don't know if Stephanie believed me when I said we were going to get two people somewhat known for disagreeing, who just split the Nobel Prize, who would end up advising us on how to invest in a fairly similar way. And I think, and you tell me if you disagree, I'm partly going to say back to you what you said, staying relatively passive, keeping costs low, and then tilting towards some known, what the academics call anomalies. In English, stuff that beats the market. Value investing being the most premier one. I would also mention momentum investing, low-risk investing from Fisher Black. Do you think that's a reasonable way to invest, and would your portfolio end up looking pretty similar to Gene Fama's?
Yeah. Actually, I recommended DFA some time ago as a possible investment. Now, they might have kind of a high fee, which concerns me, but in terms of their general strategy.
Well, let me change my tack, Professor. If AQR can beat their fee by 1 basis point, I'm just joking about that.
Yeah.
Should individuals trade? We hear about high-frequency trading and whether markets are rigged against them. Should they be trading at all?
Ooh.
I don't like this rigged story that Michael Lewis is telling. That's being a little sensationalist. I think that it might be a good thing. Yeah, I think for people to trade occasionally. You don't want to trade too often because you'll lose in transactions costs. So occasional trading. But I think in the United States.
Isn't that a positive for HFT? When we talk about losing in transaction costs are lower today than they have ever been.
Right. Yeah, so I wouldn't worry too much about millisecond trading. And I think that from time to time, one should trade one's portfolio, at least to rebalance. But more generally, when the market is looking crazy, I think we have to have people willing to get out of the market. That's what makes markets efficient. The irony is that Fama's efficient markets hypothesis, if it were accepted by everyone, the markets couldn't be efficient anymore because there wouldn't be anyone enforcing efficiency. And that is partly what actually caused this financial crisis. Too many people wanted to be free riders on everyone else, and they just assumed that the markets were right. And that led us into trouble.
Yeah, I actually alluded to it earlier, and I'll try to be a bit of a peacemaker here. I don't think you mentioned Gene believes in perfect, efficient markets. Sometimes he gets pigeonholed that way. He told us in class, this was in the 1980s, that markets are, I think the quote was, almost assuredly not perfectly efficient because of exactly what you're saying. There's information costs and reasons like that. Someone has to make them efficient. It's Grossman and Stiglitz. See, this might not work for the world, but for me and Bob, we could just say things like Grossman and Stiglitz and act like we really said something.
I got that.
But I do think, and I think you'd agree, that Gene would think they're more efficient than you do. So there is, I'm not pretending there's no difference.
Okay, then help me understand. What would the perfect-ish portfolio consist of, right? If everyone has different theories, but at the end, the same takeaway. Robert, if you were to put together a portfolio, what would be in it, generally?
Well, you have to remain fairly diversified. That's a question of what does it mean to be diversified, and that can get technical and difficult. But you also have to consider your own situation. And this isn't done very often, but if you are an executive at an automobile company, you should be short, not long, the automobile stocks as a way of hedging yourself. And these are just very broad,
If you do that, Stephanie's going to do an expose on you. You know that, right?
Exactly. But Cliff, is it a good idea to be diversified? If I think Cliff Asness is the smartest guy out there, but I have no track record history for you in the credit markets, do I want to see you diversified across asset classes?
Well, first, let me make just a broad statement. It is a good idea to be diversified. Anything you're not doing yourself, if you're running your own portfolio, which I don't necessarily really recommend, and you know you're very diversified, you don't have to diversify from yourself. But when it comes to trusting other people, there's no one on earth I put all my money with. In fact, I spread it out over many people. Bob's talking, I think, about things like owning the world index of equities, world indexes of bonds. Then Bob, I, and Gene all seem to agree on the value effect. So let's focus. It's like all good negotiations. You start out with what you all agree on. We'd probably all start with a pretty diversified world portfolio of stocks and bonds and tilt. Still own a lot of different things, not own one cheap stock. Tilt towards cheap stocks. My portfolio, I would do more than that. That's my business. There are other things I believe in. But my portfolio, and I'm going to guess Bob's, which would look something like that to begin with. And Bob can, winning a Nobel Prize, even before that, he's allowed to comment for himself.
Bob, what do you think? I guess my fear is style drift, because when I think about just before the financial crisis, when all these managers started getting into products that weren't their expertise, and then the market turned for them, they were frozen and couldn't get out. So one might say, just stick to your knitting, don't diversify.
That's another theory. What? Put all your eggs in one basket and watch that basket. Who said that? Mark Twain, I think? You know, the real big difference between me and Eugene Fama, having spent a week with him, is not any concrete difference about portfolio diversification. It's what Gene doesn't. Maybe he has, but he doesn't refer to psychology. He doesn't refer to sociology. He doesn't think there are fads and fashions. Or maybe he thinks there are fads and fashions, but he doesn't bring it up. It's not in his genetic profile to ever bring up something like that. When I look at markets in the real world, I see fads and fashions, and I feel skeptical about them, especially if they're related to traditional measures of overpricing, and I want to downweight those things in my portfolio. That's just not in Gene Fama's vocabulary.
Professor, if I may, I'll play the role of Fama here. Not only was I a student, we go to the same barber, so it works well.
You love fads and fashions?
No, well, in fact, I am, and my firm is somewhere in between. I think, for instance, cheap stocks beating expensive stocks is a combination of being somewhat riskier and not perfectly rational markets, which are fads and fashions. If anything, I wrote my dissertation for Gene on the success of the price momentum strategy, which he was very open-minded and kind about, by the way. Good mentor. And it's very hard to justify that one. That one's a tough one to justify. Maybe one day we will, but to justify why winners keep winning in the short run over 6 to 12 months is a hard one for the efficient market guys. But playing Gene, he would say, and I've heard him say things like this, I won't get the exact wording right, the behavioralists are great at telling stories about behavior, and he believes them. He doesn't think humans are robots or perfect, but they're not as good at saying how they get into prices. When there is a fad out there, and I would have to say, my sense is they do get into prices, particularly when extreme, but we are still fairly imprecise in how we in our knowledge of how that process works, and I'm curious how you would respond.
Yeah, I mean, I teach efficient markets. By the way, I like Gene Fama. I think that he's a brilliant academic, but doesn't always say things exactly right. And so I think there are a lot of what happens. It's just my view of world history. It's not just in finance. It's in politics. We have these crazy wars from time to time. You go back and look at any one of them in history and you think, what were they thinking? You can't even imagine it in future times. I think stock market movements are like that. Now, they're still hard to forecast. And that's because there's a lot of people trying to forecast the craziness. That's part of the job of being an analyst. And people are doing that job. So the market has kind of discounted into it optimal expectations of future craziness. But the craziness doesn't go away from that. It still remains.